broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, as always, my colleagues Sonia and Surabhi. Guys, hi, morning.
Hi, good morning.
The world's still holding together. We're still alive, guys. That's enough reason to be happy, right?
You know, every morning you wake up and you're like, which is the next big bank which is going to give us some bad news? And then today there's something on Credit Suisse, yesterday something on some other bank. I mean, every day is a new day and there's so much news flow, right, to negotiate.
You know, I said on closing bell, I think 2 days back, I said it's a prediction that U.S. regional banks will not blow up the world.
You did say that.
Right? I said those issues will be behind us in a week's time.
I thought that you were saying that in a good way, that, you know, they'd be behind us.
But I don't think that U.S. will pass on the baton of worries to Europe, right? Which is the new epicenter in a way. So let's just quickly run you through what really happened. You know, I'm calling this is a headline trading market, right? So markets are on headline watch. I think that's perhaps the best way to put it. So US banks, as I said, have passed on all the worries to European banks now. Latest worries, of course, unless you've been living under a rock, is centers around Credit Suisse, which is the Swiss banking giant, and of course the collateral damage it can do. Unlike US regional banks, Credit Suisse, according to me, is a much bigger worry because of its vast global linkages. I mean, its collateral exposure, operations around the world, etc., which was not the case with US regional banks and small banks. And reflecting all of these fears, and by the way, issues around Credit Suisse are not new. They've been there, well-known, well-advertised. These are not the same issues which Silicon Valley Bank or others were facing. These were, a hedge fund blowing up, leaving Credit Suisse with losses. Actually, two of them blowing up, leaving Credit Suisse with losses. Lots of deposit outflows in the last quarter of 2022, etc. But it's at the center because of the fragility of the bank itself. Now, European Banks Index, the big European Bank Index, was down 8.5%. It kind of, in a role reversal, the fear came from Europe into US. US was trading okay, but by close, US bank index also was down about 3.5%. Mind you, even with these losses, banks were not the biggest pocket of losses in US. It was the energy sector, which I'll come to in just a bit. There was a Bloomberg story overnight, which I think provided a bit of a lift, right? Bit of a risk reprieve. I'll come to market changes in a bit, which basically said that Switzerland, the government has held talks on options to stabilize Credit Suisse. And this morning, we got a headline that Credit Suisse, will borrow about $54 billion from the Swiss National Bank. This is just this morning, and I think that is causing a bit of a reprieve. Of course, in an environment like this, where everyone is doubtful of everything else, this will be seen as a temporary patch on a much bigger problem. But we're kind of commenting on all of this in real time. Now, how did the markets react? S&P and NASDAQ both were about 1.5% off the lows. The actual losses by close day on day were not much. I mean, actually, the NASDAQ was up a little bit. The 10-year completely flipped around from day before yesterday. It lost 23 basis points. It was up 25. It's lost 25. So absolutely extreme and wild moves. The dollar index ripped higher. The DXY was up 1%. It's at about 104.64. And oil prices saw a big crash. They lost about 5% yesterday, day before yesterday, that is, and they're down another 4%, 74 to a dollar. This is worries about the oncoming slowdown. Now, the setup is very, very simple. Just follow the screen. Don't try to be brave. Markets are in a pretty fragile place. And history teaches us that whenever there are weaknesses which emerge in the financial ecosystem, it takes time to heal. It takes time for the worries to recede. So, and of course, on top of it, with headlines coming at us thick and fast, it will be pretty volatile. Let the market give you a conclusive signal of a move. Now, levels, instead of saying, well, buy at this level, etc., let's look at upside levels. Nifty, and these are the same levels which we put out yesterday as well. We need for the market to trade above the 17,220 level for any sustainable bounce. And on the bank Nifty, we need to claw above the 39,740 level for any bounce. After yesterday's cuts, the distance between the current market price and these levels is even more. But, you have to have that for some confidence to come back into the system. Otherwise, I mean, stay away, wait and watch, and see how this pans out. Let the screen tell you what it wants to do. Sonia.
Oh, absolutely. I mean, the only thing to do right now is to wait and watch, right? And perhaps be a bit cautious because, as they say, nothing and no one is too big to fail. I mean, if you had looked at what happened with Credit Suisse overnight, it was a 30% fall in the Swiss stock exchange. I mean, and that's the second largest Swiss bank that we're talking about. So this contagion fear from the bank turmoil is something that's gripped global markets. And it's not done just yet, right? I mean, Credit Suisse, of course, will be borrowing about $54 billion from the Swiss National Bank. But apart from that, its biggest backer, Saudi National Bank, said it won't provide further financial aid. In fact, the stock, of course, the bank has had problems for very long through the course of the last 6 to 8 months. But the stock for the second day in a row hit an all-time low and plunged 30%. So that will definitely have ramifications across global markets. Europe was under a lot of pressure. Asian markets this morning are also indicating, a red start. At least most of the markets I saw, like Hong Kong, although the SGX is seeing a bit of a relief. But it's had a blow across most markets. First, that's the Hong Kong market for you, 300 points gone. For our own markets, the sell-on rally trade is something that continues to play out. Yesterday, we closed below 17,000. And now, in the last 1 month alone, the Nifty has lost over 1,000 points in one single month. So that's the ferocity with which this fall has come through. FIs as well, once again, selling continues. 5 consecutive days now. And FIs have sold over 7,000 crores. So the bulls are definitely on the back foot. How much more is the selling pressure going to come through? That we'll get to know. For now, even if there is a pullback, it could be a shallow one. And there is this banking turmoil is having a snowball effect into other asset classes as well. Just look at what happened with crude overnight. There was a big slide. In fact, Brent is now at the lowest level since December of 2021. That's the NCDEX, but the Brent crude prices are now below $74 a barrel, I think, 73.96. So all across, there is caution. There is a damage. It's called what? Collateral damage, right? Across asset classes. So let's see. I guess it's just better to have a little bit of patience is a good virtue. So it's just a little bit of more patience and wait and watch.
Oh, absolutely. I've just been thinking, what are the odds? How do you have a career and live through not one but 2 crises? I mean, right now this is a mini crisis, nothing compared to what we've seen in 2007 and 8. But that's going to be something, if in our careers we end up seeing like 2 full-blown global banking/financial crises,
and
not looking forward to it.
And
a pandemic in the middle. That's just a lot to, digest in a 20, 30-year career. But anyway, just to get back to the screens right now. So Asian markets, as Sonia was also pointing out, it's still largely red. It's very, very iffy. The dollar has cooled off a tad bit. It's at 104, but then it went to 105 overnight. So it's just, little change here and there. Some interesting sort of aspects. I think the biggest question now on everyone's mind, everyone who's in any market, is what will the Fed do next? So let's look at what, the Fed Watch tool is saying. Now, that's the present target rate. We know they're at 4.5 to 4.75. There is around, it's almost even, Stephen, between 0 hike and 25 basis points rate hike. In fact, the last time I checked the probability, we were talking 51.3% saying no change, not even a 25 basis points, and around 48% saying 25 basis points. And it's whichever way you cut it, this is not going to be easy or pretty for the Fed. The last thing you'd want to be is the US Federal Reserve Chairman right now, because if you cut, then the market will take it as a symbol of more pain, more problems ahead. If you don't cut, and or rather, if you go ahead and hike, then the market will probably throw a tantrum saying, okay, the Fed is not taking cognizance of the pain in the markets around the world. So that's the Fed for you. Just a point, levels have come and gone, so nothing is sacrosanct in our market. That was Dr. Doom, Nouriel Roubini. He has been consistently speaking and tweeting and talking since yesterday, saying that Credit Suisse is a Lehman moment. We're talking $700 billion in assets connected across the global financial system. And the extent of those interlinkages is not even clear right now. In fact, he's going on to say that right now this is not a credit problem. This is an asset liability mismatch across banks because of the way interest rates have moved. But he's arguing that eventually you get to that recession and then you start getting credit quality problems as well. So he's really going all out in terms of predicting a doom scenario. But just to come back to the data and the relevant factors here at home, we are a whisker away from the September lows. The last low that we got was 16,747. Just wanted to put the number out there for specifics. The FPI data that Sonia alluded to, they've started selling, and the net positive number for March is going down. So far in March, we are still positive, but that's to the tune of around 12,500 odd. And this is largely because of block deals. We don't have X of block deal data very clearly. So therefore, this number is looking not as bad. There were sellers in January, in February. They became buyers only in March. So let's see how that plays out. Last but not the least, I was hearing yesterday from a couple of people that I was speaking to, Prashant, that if you take out the SIP numbers, even mutual fund inflows haven't been rosy. In fact, we're net negative, right? Minus the SIP number.
No,
so where does the support really come in from?
That number has been negative for a few months. And you said Lehman. Guess what the name of the chairman of the board of Credit Suisse is?
Lehman. Axel Lehman. I mean, that is just
make this
Let's not say that word too many times, guys. And don't manifest
I just saw. I
things.
said, really, I had to go and anyway. Two ends at the end, not one. But anyway, the resemblance is freaky. Well, before we move on, let me quickly tell you what is lined up in the first half hour of the show. We get you updates from markets across the globe. Jahangir Aziz is a conversation you don't want to miss. That's coming right up. Our research team will bring you our top 10 list of stocks to watch. At around 8:30, Anand Tandon will join in for a quick market conversation.
Okay, by the way, before anything, gold prices, we forgot to mention that they're zooming. Generally, when there's risk aversion towards equities, gold rises. Gold is now at over 57,000 rupees. And in the global markets, gold has gone up to above $1,900 per ton. So, just keep an eye out on that. 1911 now on the precious metal. Well, on the equities front, we have Eric Fishwick of CLSA who says that if global markets require rates to be cut to regain confidence, it puts both US and the European Union in a bind. Without cuts, he says risk aversion rises, financial conditions tighten, and the crisis tail gets fatter. With cuts, he adds, looser financial conditions minimize the economic impact of market turmoil, making lower rates inappropriate from an inflation perspective. He says that he does not have a solution for the paradox, but separation of liquidity, balance sheet, quantitative easing or tightening decisions from inflation and the rates policy would be a good starting point.
Okay, let's get you some money market views as well. And this is the view coming in from Parul Mittal Sinha of Standard Chartered, who says the USD INR saw upward pressure on a spike in global risk aversion. A slip in yields and equity sell-off, even as a drop in oil prices, helped limit that upside. She expects the USD INR to trade in a range of 82.25 to 83.25 next week, with volatility possibly checked by USD sales. She says ECB FOMC policy decisions are on watch, with dollar and oil price moves likely to stay key forex drivers.
All right, and on the bonds, Parul says domestic yields slipped last week, tracking a sharp down move in global yields with pricing of central bank rate hikes correcting lower amidst high market volatility. She expects the 10-year yield to trade in a range of 7.3 to 7.40% next week, with global yields as the key driver. She says all eyes are on the ECB and the FOMC policy decisions due today and on March 22nd, respectively, for further market direction.
Okay, so there's a lot of macro news points to watch, but we do have a lot of stock-specific action as well. So let's quickly run you through the list that we'll cover in our top 10 segment. We're looking at ONGC, Oil India, Interglobe Aviation, Asian Paints, Godavari Power and Ispat, Sarda Energy, and Orient Paper on the upside. Positive news flow surrounding them. Samvardhana, Motherson, Hero MotoCorp, and Patanjali Foods are stocks that are likely to open in the red. We'll tell you why in just a bit.
All right. Well, we spoke with the former governor of the RBI, Raghuram Rajan, on the current issues. Listen in.
SVB is more systemic because the same problem exists across a number of small and medium-sized banks in the US, that they have splurged on deposits. This is something we pointed out at Jackson Hole in a paper, and that they have invested, and that's what's coming to light in long-term assets in a search for yield, and therefore are subject to a lot of duration risk. That's, I think, a common problem for a number of small and medium-sized banks. That's why it's a little more, there are a large number. It's not a problem for the money center banks in the US. In Europe, Credit Suisse is a large bank. Large banks, if they run into problems, are systemic because they have interconnections with everybody. But it's not that every other bank has the same problem that Credit Suisse has. The Fed is in a tough situation. The CPI report that came out yesterday is not a comfortable one. Core inflation in the US is still going strongly. Inflation has come down, but that was, in a sense, the easy part, the supply chains rectifying and so on. The tough part now comes bringing it down to the 2%, 2.5% that the Fed will feel comfortable with. If the Fed sees that the financial sector stabilizes, it may still go with a 25 basis point hike. I think 50 is off the table.
Okay, we have someone who's, I dare say, seen it all. Jahangir Aziz is head of emerging markets, economics research and commodities at JP Morgan. Jahangir, great to have you with us here on the program. Thanks very much. Let's just start with the latest problem, which is the banking giant Credit Suisse, which seems to be the epicenter of the troubles currently. Now, problems there have been well known for a while, well advertised for a while. Shares were down massively even before the latest episode of a sell-off. Do you really think, I mean, is it likely to fail, let me put it very plainly, and then cause a worldwide contagion? Or you think it'll be contained? What's your sense?
I mean, you've seen the moves by the Swiss government or the promises that you just spoke about. I think Credit Suisse for the Swiss government is large enough for it to be backstopped by the government. So I don't really think that you are going to see a failure of that. You can probably see that being, other banks coming in to bail it out, or the bank being restructured and different parts of the bank being separated, which was in the first place the plan to do so even before this event happened. So I really don't think that that is a bank that will fail, and you will see this massive contagion effect. I think though there are two parts to the story, right? One part of the story that we are all in the market and we all worry about the equity prices. There is the equity angle to it. And then there is the impact that the Credit Suisse has on the real economy in terms of its impact on actual credit that it actually delivers to let's say the Europe and to the rest of the world. I think the equity impact we've seen, it's terrible. It's really, really hard. So clearly equity owners of Credit Suisse will have been already battered by it. But that does not necessarily mean that the credit impact of Credit Suisse is going to be that bad, right? So I'm not saying that there won't be a credit impact. There's clearly likely to be a credit impact, but it will be taken over by the other bigger banks in the European time zone.
See, that's something that we can only guess, right? I mean, no one knows which way things are going to go. But the big question, Jahangir, I think the million-dollar question is what happens with the Fed? Because the Fed leadership for the last 1 year has been targeting inflation, with rate hikes, etc. But now things are changing on a dime with this whole banking crisis unfolding. What do you see the Fed do next week?
So I know this word is being thrown around because it's an easy word to use to describe the situation as a banking crisis. If you're going to call this a banking crisis with two small banks, relatively small given the size of the U.S. economy, and let's say a handful of other regional banks also follow the same pattern as Raghu pointed out in the previous segment, then we really need to invent a new word for what happened in 2008. So I really don't think that this is a crisis, right? So first of all, let's just think. Secondly, if you have the largest bank in the world, central bank in the world, the Fed in this case, raise rates by 500 basis points thereafter, to expect that nothing is going to break would be something that has never happened before. When central banks raise rates by these kinds of levels, things break. When we talk about things, we never specify what things will break, largely because what will break depends on the specific balance sheets of these entities, the plumbing of the system. So the micro impact of these macro moves, we never really specify. But to expect that even in this soft landing scenario where the U.S. economy, which is running red-hot labor market, will actually cool down to a mild recession and nothing is going to break in that process, that was a bit too much because that never really happens. So I think that even though we try to describe it in a very benign fashion by calling it a soft landings always include things breaking. Now, the question is the break large enough to stop the Fed from moving, which was your question. And right now, we don't think it is. If you look at what's happening to the labor market, what you've seen, what happened to the CPI, none of that points to the Fed actually pausing. We do expect the Fed to go 25 in March. We also expect the Fed to follow it up with a 25 in June. Without that, is almost it is very unlikely that you can even get a soft landing if the Fed doesn't do that. And just to I mean, I'll shut up after this. Imagine this conversation taking place a week back. We will be talking about the Fed going with 50. So I think we need to put things in perspective a bit. Okay.
Absolutely. Jahangir, good morning. Great to listen to you as always. So to be here. I was looking at the CME Fed Watch tool. Now, a majority are saying no hike. Only, I think, 48. Last I checked a couple of hours back, were saying 25 basis points. So no hike is also on the table, it seems. But, my question is this, and I'm simply going to paraphrase Nouriel Roubini, Dr. Doom, as I ask this question. His argument is that once you get that landing, a soft or hard or some landing in the US, and as you're saying, things will break, that's when the credit problem starts to occur, which we haven't seen right now. And that's when you get into a full-blown crisis. That's his argument. I'm only paraphrasing it. But your thoughts to that?
My thoughts are that even to get to a soft landing, credit has to slow down, and has to slow down significantly. Without a significant credit slowdown, how are we going to engineer a soft landing? Even that requires credit to slow down, credit conditions to tighten, banks to reduce lending, corporates, and in all of this, there will be micro stories in which some banks will go down under, some corporates will go down under. There will be sectors that will be hit much more than the other sector. And again, I'm going to go back to this description that the soft landing does not mean what we imagine it means. It's not a nice little glide down to some reduced growth rate and inflation automatically falls. So even if we do not even get to the point that Roubini is talking about, even in that process, we need credit to slow down. And credit slows down either from the demand side, when consumers and corporates, because of the higher rates of lending, do not want to borrow more, or from the supply side, where these increases in interest rates, deposit rates, losses to your investments actually forces banks to become or tighten lending standards, and they reduce lending. So both of them will have to happen. You really cannot imagine that economy of the size of the US slowing down after 2 years of red-hot economy without things like this happening.
Okay, your years of wisdom have provided it soothed our frayed nerves, I must assure you that. Because, you wake up every morning, and as commentators, you wake up every morning to news flow. You don't know how things are going to play out. But then we have experts like you joining us and telling us, you know what, it's okay, it's not a banking crisis.
But Sonia, I think he's just saying it nicely. He's still putting out all the worry points on the table. He's just saying it nicely with a smile, so at least we feel better.
Okay, glad to know that there's no failure of Credit Suisse coming anytime soon, and neither is this a banking crisis. At least that's your view. Jahangir, always a pleasure speaking with you. We'll catch you at another day. Thanks a lot for joining in. All right, that's JP Morgan.
By the way, on that Fed question, right, I mean, that proverbial saying, between a rock and a hard place. So we have the first test of that with the ECB meeting today. Yeah. So Fed is next week. ECB meets today. Till a week ago, people were saying ECB will hike. Consensus was for a 50 basis points hike.
Yeah.
And now in Europe, you have Credit Suisse and banking worries. Yeah. So rock, hard
Would you
place.
ever want to be a central banker, Prashant? Ever thought how it's like to be a central banker? Would you want to be one right now?
A little late in the day for that.
All right, we'll take a very quick break here. Our team's list of top stocks to watch lined up next. Stay with us.
All right, well, let's begin a brand new day. And since we've spoken a lot about the macros, let's now drill it down to the micros. Our research team is standing by to give you a list of top 10 stocks as we head into trade. Vivek is here first up. He's tracking, once again, all the block deals and a lot of the data on corporates. Vivek, you're looking at Samvardhan Motherson today?
Well, absolutely right. It's another one in the list of long block deals that we've seen in the last couple of weeks. So Samvardhana Motherson will remain in focus today. The Japanese promoter Sumitomo Wiring is looking to sell almost 3.4% stake in the company, and this is most likely going to happen via block deal in today's trading session as per sources. Now, the floor price for this particular block deal is very interesting, a significant discount to yesterday's closing price. 69.9 rupees a share is what the floor price for this particular block is, and the total deal size is almost valued at $195 million. Now, remember, at the end of the December quarter, Sumitomo Wiring held almost 17.55% stake in the company, and as per the term sheet that we viewed, we understand that there is now a 180-day lockup, for further sale of shares. It's an intention that Sumitomo Wiring has actually said as far as this particular block is concerned.
Okay, thanks a lot for that. Well, I'm watching out for Hero MotoCorp, and I'm expecting the stock to be in the red today, and I'll tell you why. Honda launched the 100cc Shine bike yesterday. Now, that's important because Shine is a very popular brand of Hondas. They have 125cc and above motorcycles, but now they've come down in the 100cc category, which is a very competitive category, and B, it's not doing that well because of, no recovery seen in Tier 2, Tier 3 and the rural markets. The pricing of Shine is also competitive compared to current players, and Honda spoke to my colleague Santya yesterday, and they said that they are looking to increase their touch points in Tier 2 and Tier 3 cities. So they are very aggressive in this space. Now, Hero Moto is currently the #1 player in the 100cc segment. So UBS put out a note this morning where they said that this 100cc Honda Shine could dislodge Hero MotoCorp from its #1 position. It's the only segment in which Hero is untouched so far. All the other segments, Hero has sort of lost market share. And this is the segment now where there is once again competition. So I'm going with red for Hero MotoCorp this morning.
Okay, so that's Hero Moto in focus. Let's move to Patanjali Foods, where we had news coming in on the exchanges. Mangalam, morning. So they're freezing promoter shares. Basically, they can't be traded?
Yes, the promoter shares cannot be traded, and that's the notice which is coming from exchanges on account of SEBI's minimum public shareholding guidelines. But it is important to know that the promoter shares were locked in till April 2023 already on account of the FPO that took place same time last year itself. The promoters of the company hold about 80.82% stake in the company, and this had to be reduced to 75%, increasing the public shareholding from just below 20% to around 25% itself. The company says they're confident of achieving this mandatory minimum public shareholding within the next few months. The stock exchange's action will not have any impact on their financial position. The big question, however, is what took them so long? The company says it was market conditions. Remember, the current price of the stock is 960 rupees versus the FPO price of 650, but the stock is down 36% from its 52-week high already. So we expect the stock to open in the red, but thereafter, post the commentary coming in from the company, let's see whether there is some recovery or not.
All right, thanks a lot for that. Well, we will be speaking with Sanjeev Asthana, who's the CEO of Patanjali Foods. That happens on Bazaar at 9 a.m. today, so you'd want to stay tuned in for that. Right, by the way, some news flow coming in. This is a big investment coming in from Adya in Lenskart. They will be investing $500 million. It's interesting, we spoke to Kedara Capital yesterday, the private equity fund that has investments in Lenskart, and they said that this is a great business moving up, and this is hopefully something that will happen very soon. And now the large investor has come through in Lenskart. So interesting development in the e-commerce space. But let's do one thing. Let us talk about the other big headline, which is crude. There was a massive slide that happened overnight in crude. In fact, for the past few days, Brent, I think, is now below $75 a barrel. Manisha Gupta is joining in to give us an update on all of that and the impact it perhaps could have on, certain sectors as well. Manisha, over to you.
Thank you for that, Sonia. Well, yes, if you look at the last 3 trading sessions, we've seen the WTI crude oil prices lose by 12% and the Brent is down by 10% as well. And it's trading at a nearly 1-year lows as we look at the crude oil prices right now. There has been strength in US dollar index back yet again. The hedge funds are liquidating longs that they have been holding in crude. And then the rising interest rates, economic uncertainty, risk-off sentiment is all weighing onto the markets here. The crisis in the banking sector could trigger cut in demand is what the street is worrying about right now. And add to that, you've also seen the US inventories rise by 1.6 million in the previous week. So everything is weighing on the crude prices right now, with the markets anticipating that another $4 to $5 of a decline from here is not ruled out before we start seeing some stability into the markets there. Not just crude, natural gas fell 5% overnight. Heating oil prices are trading at a 1-year lows. So everything in the energy markets right now trading in the negative.
Yes, that is the case in most asset classes as well, Manisha. Thanks very much for the updates over there. Some more stocks and news. Let's go across to Rima for that. Rima, morning.
Hi, morning. So Godavari Power and Ispat board will be meeting on Saturday, the 18th of March to consider a buyback. Sarda Energy has received the consent to operate from the Environment Conservation Board of Raipur for expanding its existing rolling mill capacity. So that's a positive. While Orient Paper has announced a capex plan of 475 crore towards modernization and debottlenecking of their manufacturing facility at Madhya Pradesh. Back to you.
All right, thanks a lot for that, Reema. So this is a list of our top 10 stocks in case you missed out on any stocks with positive news flow. All the crude-based companies that use crude as a derivative or as an raw material. So all the aviation stocks, paint companies, ONGC, Oil India could all be in the green this morning. Godavari Power and Ispat as well, Sarda Energy and Orient Paper. While stocks with negative news flow, there's Samvardhan Motherson, there's Hero MotoCorp, more competition there, and Patanjali Foods as well. We'll take a quick break on that note. On the other side, Anand Tandon will be joining in for some fundamental stock analysis. We will also have the CFO of Dixon Technologies, Saurabh Gupta, joining in. Media reports indicate that the company is eligible for an additional PLI scheme of 150 crores. More on that in a bit.
Well, for what it's worth, the last I checked, the SGX Nifty was trying to hold its head above water. Let's see if that situation is still the same, about 30 points up. Don't know if that really plays out at all, but anyway, it's for reference on the screen. Let's take the conversation to Anand Tandon, who's joining us. He's a fundamental expert on the show this morning. Anand, good to have you on, and good morning to you. We live in very, very interesting times, right? Never thought would be seeing so many crises in, in a span of, 20-odd years. But you tell us, I mean, how would you look at the market right now? Would you start putting some money to work, or would you stay on the sidelines and wait for things to settle? How would you approach a situation like this?
Well, Surabhi, thank you for having me. Broadly, if you see what's been happening in the US, it's essentially now for the first time the effect of interest rate hikes are becoming visible. In India, we haven't seen that yet. So from that perspective, I would argue that the markets still need to react to the fact that the interest rates have moved up. We have begun to see that only marginally, for example, in the mutual fund industry, where the SIPs have been rolling off and new ones are not coming in with the same kind of volume. And the move towards debt has started. The question is, how will that affect valuation? I've been arguing for a long time that in a rising interest rate scenario, PE expansion is not possible. In fact, contraction has to happen. And you are beginning to see some of that happening. Unfortunately, if you look at the sectors where the growth is given, which is essentially sectors like banking and finance, to some extent capital goods and perhaps even consumer staples, etc. All of those are still trading at much higher than what they have in the past. So from that point of view, I think frontline indices will have a struggle, at least for the near term. With that kind of context, I think you still have to look at only those companies where there is growth that is more visible than not. And again, it comes back to these same sectors. So it's a question of timing. I think the market has given up most of the fluff. We have to wait perhaps just about a little bit longer for you to start looking at buying aggressively. For now, I think, as you mentioned, you could start nibbling around, but it's always better if you are looking at trying to time it to wait for the market to rebound before you start actually putting up serious money.
Got it. The other big headline, right, and it's a real concern now, is this El Nino effect and the impact it would have on monsoons. Now, there are two global weather bodies that have declared a watch on El Nino and perhaps a likelihood of it arriving by July of this year. And on stocks like, say, M&M, for example, it's already lost 10% of its value this year, perhaps in anticipation of weak tractor sales. Your thoughts? Would you use this as an opportunity to buy into some of these names?
I think I would. I think, my bet at least is that, even if the crop volumes are not as much, I think the prices have gone up considerably. If you look at, for example, the MSP that the government has announced versus the kind of market price we are at, you would argue that there's going to be less procurement by the government because the market prices are way higher. So to my mind, one of the possible plays during this, over the next 6-8 months will be the fact that rural growth will revive stronger than perhaps we have seen in the past. And incrementally, I would argue that rural demand is what is going to drive rather than urban consumer demand. So from that perspective, companies that have leverage in terms of the rural economy is something that I would favor.
Anand, stay with us. Amidst all of the global gloom and doom, India's February trade report once again shows that the country is likely to post a current account surplus this quarter. February services exports are up 37%. Lata is here with more details. Lata, good morning.
Good morning. Yes, I think this is a structurally important story. We've always been cribbing about twin deficits, remember? I think one deficit, current account deficit, is just disappearing for now at least. Now, the February data, if you add goods plus services and deduct the exports from the imports, the deficit is as low as 2.8 billion. Year ago, it was almost 10 billion, 9.5 billion to be precise. Now, if you take just the 2023 Jan and Feb numbers, then again the deficit goods plus services is just 2 billion. Last year, it was 13.7 billion, average for 2020 for 2022 calendar. Now, this is primarily because of the extraordinary performance of services. The services trade surplus. Again, we also import a lot of services. Again, deducting imports from exports, the services surplus was 14.6 billion in February, and that is 76% higher than what it was a year ago. The services surplus was just 8.3 billion. Now, if you take only services exports, not the imports, that is almost $30 billion in February. Again, year ago, it was only 21 billion. That's a 37% jump. Goods is still a trade deficit. Yes, trade deficit is 17.4 billion. Even that is quite, a good 10% less than what it was a year ago at 18.7 billion. In fact, if you took the goods trade deficit from April to December, we were averaging 25 billion. Now look at the deficit. It's 17.4 billion. Again, a sizable fall in the goods trade deficit. So my primary point is that Jan and Feb, in fact, the services exports of the last 1 year is clearly indicating that the current account deficit is not going to be a problem. Rupee is not going to be an issue. Let me end with just one negative. The February goods imports and exports are 8% lower than year ago. So clearly there is some slowing of the Indian economy, but that apart, the big deficit concern is not going to be there in the near term in terms of the external current account trade deficit.
All right, Lata, thank you very much for that. And that is comforting, isn't it, amidst all of this noise which is hitting our shores, which at some point in the future, fingers crossed, will cause some slowdown, manageable, I guess. Anand is, of course, still with us. Anand, just for viewers watching, I mean, I'm assuming all the viewers who are watching have some exposure already. So what you will do from here depends on what you've already done. Having said that, if you have surplus cash to invest, would you put that to work now, or and in what way? If you can be a little more specific.
So let's say you're looking at an average investor who usually follows a 60-40 allocation. Since that's the benchmark, we can start with that. I would argue that you are still not in a market where you should be doing a 60-40 allocation between debt and equity. Debt is far more attractive for the next 12 months than equity is on a risk-adjusted basis. So you would perhaps, for example, continue to buy a dynamic bond fund to maybe 50% of your equity of your portfolio. You can start putting, let's say, 25% of your incremental cash into the equity markets. Maybe there is a reason to be buying gold, for example. So the rest of the money can be allocated between a gold and cash. There is a concept of a cockroach portfolio. A cockroach being one which can survive a nuclear attack. I had actually written about this in one of my articles some time back, that this would be a year where a cockroach portfolio would do well. Broadly, most portfolios, including 60-40 portfolios, are geared towards growth. If you have a situation where you have high inflation and not particularly strong growth, you will not be protected in a 60-40 portfolio. So you may want to diversify into precious metals and cash to some extent. So as I said, using 60-40 as a benchmark, I would be underweight equities even today, and perhaps slightly overweight, or at least have some weight in precious metals and cash.
Okay, that's the first time I heard that word, cockroach portfolio, but I guess you learn something new every day. Thanks a lot, Anand, for joining in, and have a good one. That's a word on the market. We have 15 minutes left for the pre-opening rates to come through. So let's get a quick corporate voice in. The government has cleared another tranche of the PLI scheme incentive worth 765 crores. According to media reports, Dixon Tech is eligible for incentives of about 150 crores from this tranche. The company in FY23 so far has booked PLI incentives of 8 crores. To get more details on this development, Saurabh Gupta, the CFO of Dixon Technology, is joining in. Saurabh, good morning. Before I ask you about the PLI incentives, I have to ask you about the slowdown that you're seeing in your mobile business. The last time we spoke to you, you said that you've lowered your guidance primarily because of this slowdown in mobiles, as well as the pressure that you're seeing on the export side. Have you seen any recovery at all?
Yeah, good morning, Sonia. So absolutely, I think so. Q4 is significantly better than Q3. Our order book with our anchor customers is much better, and they have given us some kind of visibility for next financial year as well. And in this mobile business, the markets have picked up as against the Q3 quarter, but still it has not come to the same levels as last year. And in this mobile business, we are looking for some more large customer account acquisitions, which we are hopeful of concluding in a very short period of time. And those will have some numbers coming in from next financial year as well. So combination of existing customers as well as new customers, I think so this business looks for a good growth for us for the next financial year.
Okay. Saurabh, hi, good morning. I just want to understand what's happening with respect to the PLI monies. We believe the government has released a tranche and Dixon was looking to get about 150 crores. So have you gotten the money and how does it get booked out? Because obviously the PLI incentives are tied into revenue milestones. So how will this be accounted for?
Yeah, so we have got the approval from the government. I think so the money should come into the system in the next couple of weeks. The way it is accounted for is that you need to achieve certain capex and revenue thresholds each year. Once you achieve that, you go to the government, apply for the same, government approves it. So we have got the third tranche of PLI. We are the only company in India across 14 PLIs and across the mobile PLI, which has got all the 3 PLIs from the government. And we are absolutely sure of achieving those thresholds for the next financial year as well. So we are just waiting for that money to come in, and some part of that incentive is shareable with the customers, and some part of is retained by us.
Saurabh, last time we spoke, you had said that it's very difficult to give a guidance for FY24. And you said that we'll have better clarity in the coming weeks. Can you put out a number now, possible? The earlier number was 19 to 21,000 crore range.
So Prashant, as a company, we have decided that we will not be able to give a guidance for the next financial year. There are a lot of moving parts in the business, the global scenario, the interest rate scenario, the inflation, and the demand scenario is not that good as of now. So it's very difficult to predict. So what we can say is that we will continue to grow and will continue to outperform the industry growth, is what I can see. And we will continue to take higher share of order from existing customers and continue to add more customers.
But you said that FY24 revenue guidance is likely to be lowered from 19,000 crores. Would you not lower it now, given that things have improved?
Sonia, I actually don't want to give a number on any kind of a number. Yeah.
All right, got it. Thanks a lot. I mean, we understand that it's the evolving situation and it's a challenging time, but thanks a lot, Saurabh, for joining in. So Q4 is better than Q3 and the mobile business market has picked up. I think that will be music to the ears of Dixon Tech investors. Let's slip into a quick break. On the other side, we'll have Mitesh Thakkar and Sudarshan Sukhani join in for some technical tips. Stay tuned.
Okay, welcome back. We're about 10 minutes away from the pre-open session. These are historic markets that we're reporting on. Extreme and wild moves overnight once again. SGX this morning indicating a 30-32 odd point higher start. Anuj is here with a take on how he's looking at things. Anuj, hi, morning.
Morning, Prashant. Obviously, that lifeline being extended to Credit Suisse is helping global markets, and SGX Nifty participating in that. I think what you have to differentiate here is the trading versus investing approach. The trading trend is clear. Sell on rally, and I think yesterday it was the best example of that. But my sense is it's good time for investors to perhaps start nibbling, because I don't think Indian banks, for example, are impacted by what's happening globally. Lehman, for example, was the best time to buy banks, right? And that was a time when there was a lot of panic. The market is very oversold. Maybe even a trading bounce is also due today being expiry. But we need to protect 16,800 to avoid a bear market. I'll just show you a channel on the Nifty, and that's a very important channel. And if you look at this channel, the markets respected that. At higher level, there's been selling, and at lower level, there's been buying continuously. And now we are very close to that lower end of this channel. This channel's low is somewhere around 16,750, 16,800, and that's why this level is important to defend. Now, if we talk about a Nifty outlook, yesterday fell from the conviction zone of call writers. The high was 17,211, in the middle of 17,181 and 17,242. For today, those two levels are 17,054 and 17,123, which gives you a midpoint of 17,088 or thereabout. I think on the Bank Nifty, though, that's a problem, because yesterday the Bank Nifty made a very strong bearish red bar, and I think you need to negate that because there's been a lot of call writing on strikes from 39,200 to 39,400. So that's your weaker component of the market just in the near term.
Okay, so we need to watch for that. Anuj, thanks very much for putting the cues on the table. Let's discuss this further with our technical experts. We have Mitesh Thakkar as well as Sudarshan Sukhani joining in for this. Gentlemen, good morning. We wake up to more scary headlines every day. There's a lot of news that's sort of moving through markets right now. Sudarshan, would you at all play for a bounce today?
Good morning. See, I've been explaining for the last many days that we are in a very volatile market environment. Volatile markets kill many trading careers, and we don't want to come into that category. The best trade is not to do anything, not to trade for a bounce, not to trade for a decline. We don't know. Yesterday, I heard that the Nifty is opening 200 points wow, and then see what happened. So that something very different could happen today, but unfortunate part is we have no idea what will happen. This is not a market to be traded. Just step aside.
All right, just step aside. I think you've been saying this for a while, that it doesn't make sense to trade such a choppy market. Got that? Mitesh is also with us. Mitesh, would you concur with that view that, with the way headlines are changing by the hour, it's better to just take a step back?
See, partially, yes. I think, when the intraday volatility shoots up like this, typically very difficult to get a good hang of levels, as well as also is the fact that, you always don't get the preferred risk reward entry equation. So yes, in that sense, but I think, what we have been doing is that when we have been wanting to sell the markets, either it's pullback, which is what we got about 2 days back when the market opened with a big gap up about 17,500. I think that was a good level to go short. Or I think, you participate via put options, which may not be a bad idea to trade the indices. So I think that's why we're approaching it. For me, I think what is important going forward is that 16,800 is a very important level to watch out for. One, we had this low made in September 22, when the intraday low was around 16,747 and the closing low was around 16,820. And then there's a big gap which was created in July between 16,700 to about 16,800 levels. So I think that 100-point band would be a very important level to watch out for. Till then, I think the markets will be choppy, and the idea would be to use good pullbacks, stronger pullbacks to sell into at higher levels. Currently, I would want to sell closer to about 17,250 to 80 zones.
Okay, so that's Mitesh's strategy. Sudarshan, take your point. I mean, the caution is well observed. What about individual stocks? Maybe not intraday. From a positional standpoint, would you want to venture out there?
Yeah, I would. You're quite right. And let me tell you, Surbi, this too shall pass. This volatility will come down, and we'll be back to the normal trading environment very soon. Obviously, don't know when, but not long now. Godrej Consumer Products is an intraday short. The stock has been drifting. Now there is some idea that, I don't know, rural demand is coming down. I don't go into that. But on the chart, it's weak. Short intraday with a stop above 918. Titan is a buying opportunity. Earlier, you were asking whether it is worthwhile. Good quality stocks are worthwhile buying into. And because you are a positional trader in that stock, you are not worried about small market movements. Buy Titan. I'm giving a tight stop of 23.20, but really you could buy and hold it. Secondly, Dabur, again same FMCG group. It's an intraday short with a stop above 530. Something is happening with FMCG. All of them are drifting down. And JSW Steel is building a small base. It's not participating in the declines. We'll see what happens, but it's worth buying into with a stop at 665.
Okay, this too shall pass, right? That's a great... great line to live by. Another one I really like is, it is what it is. You can't help it, right? This is the way the market is, so you've got to perhaps be in it. Mitesh, what about you? What are the individual stocks that you're looking at this morning?
So I have a mix of buys and sells today. On the buying side is Berger Paints. Keep a stop around 580 or just below it. Look for a target of around 615. crude is a positive news, as well as the fact that the stock held out very nicely in a declining market yesterday, and the indicator setup is positive. HDFC Bank is something which has come down to very important support levels, so good chance of a bounce back today. 1529 is what I recommend as a stop loss here, a target of 1565 to about 1570 to begin with for a 1-2 day kind of a trading position on the upside. The third buy call is NMDC. It's a buy with a stop below 115 for targets of 122, and one sell call that's on IGL. Keep a stop at 431. Look for a target of around 404.
All right, Mitesh and Sudarshan, thanks very much. Both of you appreciate it very much here on CNBC TV18. We'll come back to both of you in a bit from now. 4 minutes to the pre-open session. And I have to say that at least in the last, 15 minutes or so since we started, no global headlines coming our way. So it's status quo last hour. 45 on the SGX Nifty futures. Take a break. We are back. The pre-open, Sanjeev Asthana of Patanjali Foods will join us on the other side.